Thursday, Jan 12th, the month like that's going by. My snap is banging today. Guy Adami, Dan Nathan, it is Market Call. It's 1 p.m. on the East Coast. As I've mentioned, really the only time zone of import. Everybody sort of backs in or out of their time zones based on the East Coast. In just a few minutes, EY from SoFi will be joining us. And fasten your seatbelts, people, because Butters is here. You're going to see him. You're going to feel him. It's going to be banging or fire emoji, whatever the hell people say.
All of the above.
This market call brought to you by FactSet, Dan, financial data and analytics powered by Tomorrow. And of course, SoFi, get your money right, all in one app. Well, if you're long the market today, you've gotten your money right, Dan, for now.
Yeah. Well, it's interesting, so John Butters, we get a preview of his earnings insight blog that drops every Friday, and we do it here on the Thursday market call here. But John Butters is going to be here in the house to talk about this. I think it's actually a really important report that's coming out tomorrow because, again, we've been so focused on macro data, right? In the lead up to some of this inflationary data, everyone's trying to game what the Fed's going to do at the Feb 1 meeting. We always take a look at that CME FedWatch tool, and there's things that are moving in that tool after today's data, but it's really going to be the company earnings data to me that changes the narrative right here. We have an S&P 500 that's up 4% of the year. We have a Nasdaq that's up nearly 5% of the year. That seems like, annualize that, guy. You do that after 12 days, you're gonna have a heck of a year in 2023, right? You think that's going to happen?
I could probably extrapolate, which is a word that I don't know what it means, but I can say it. And also say, you mentioned the important part. That'd be such a great name for a podcast. Maybe we should license that.
Yeah, maybe we'll see about that. All right, let's talk a little bit about the data here because it came in kind of right in line. And again, year over year it's down, right? The last print was 7.1 year over year. This print was 6.5%. That was what was expected for the CPI here. And I think it was interesting. David Rosenberg of Rosenberg Research, you call him Rosie. He tweeted out, just as rents and good prices start to deflate, Powell decides his favorite inflation measure excludes products and shelter. He's now targeting less than 30% of the CPI. Why? Because he needs ammo to tighten further into the longest, steepest yield curve inversion since 81. Now, just to be clear, he put that tweet out before the data came out. It doesn't really matter, but I think it's interesting that what Rosie's trying to say here is he's kind of moving the goalposts a little bit.
That's exactly right.
And Guy, I got to tell you, because you and I are in the rates lower camp, okay, really reflective of expected growth. But there's a lot of people out there think that the Fed is trying to come up with excuses to stay hawkish and continue to raise rates higher than what is being forecasted at the moment.
I think that's exactly right. And, again, there've been a parade of Fed governors, officials, what have you, talking about exactly that, the need to stay higher for longer because they're not looking to make the mistakes that have been made in the past. And when you said moving the goalposts, that's exactly what popped into my head when I saw this tweet. They're effectively moving the goalposts. So if things seem to be getting better on the inflation front, they will find something that they're not satisfied with. Now, again, the market's sort of calling BS on them, obviously, early this year, and we'll see how long that lasts. Don't be surprised, though, if you continue to see these voices come out and say, hey, folks, I don't know what you're looking at, because they clearly don't want asset prices to go higher. But the thing that you mentioned, which is so important, and EY from SoFi will speak to that, as will Butters. The Fed, I think we all pretty much understand it. I think to a certain extent it's been played out, gamed out. What's going to matter now are going to be earnings. And, you can talk macro all you want, but earnings are still what drives the market. And if the earnings aren't there to substantiate the valuations or the levels we're trading at, then we're going to have a problem. And I think that's something we've been saying for a while now.
Yeah, no doubt about it. And, when that data came out, again, a lot of people are waiting. It's pre-market. The futures are trading here. And we have an S&P futures chart of just kind of yesterday's price action, which was kind of sleepy, right? And then into today. And, they didn't know what to do, right? Trading this a little bit. But it brings me back. It brings me back to the 1 year chart, though, here, Guy. And, the downtrend is what it is. The 200-day moving average, we're banging up against it right now here. And you see that little circle that we have there. That was the day of the November CPI reading. We talked about it yesterday. We had that kind of brief move above the downtrend, above the 200-day moving average. It got rejected. We're back up at those levels. Thoughts on the S&P? Because again, we're going to talk about bank earnings, and we have a massive amount of them tomorrow morning. JP Morgan, Bank of America, Citigroup, Wells Fargo. There's a few other important names that are reporting. How's the setup in the S&P looking to you? Are we going to get a breakout above it?
If you're bullish, which I think most people want to be, what you're hoping is, okay, we got this inflation data out of the way, and now we have bank earnings tomorrow for, if I'm not mistaken, JP Morgan, Citi, Bank of America, and Wells Fargo. And if they come out, and it's, again, they're not all going to say the same thing, but if the tone on the margins is positive, that's probably going to give the market enough oomph to get ourselves through this downtrend line. I am not one of those people that believe that. I think we exhaust ourselves here right at this 200-day. If Carter were here, he'd probably say the same thing. And I think people are starting getting themselves excited about these lower inflation numbers, totally disregarding the fact that we're seeing slowdowns all across the board. My sense is Jamie Dimon is not necessarily going to throw cold water on things, but I think he's going to re-emphasize some of the comments that he made 6, 7, 8, or 9 months ago. And I think that might be enough to sort of take some of the juice out of this market to the upside. And I think we fail here.
Yeah, it's interesting. Diamond did this last quarter, guy. He did an interview overseas like days before their earnings. And, it ended up being that the stock was near 50. It was trading at new 52-week lows, maybe even 2-year lows or something like that. And, the earnings came out better than expected. The stock rallied a lot and it actually really outperformed the S&P. If you look at JP Morgan's performance versus the S&P from the October lows, it nearly doubled that performance at the highs there. So that one to me is going to be really interesting because the stock has been consolidating here. And if there is a hint of increasingly, I guess, less cautious tone out of him, that stock is going to party, as you like to say. I'll just look at that thing right there. I mean, listen, take everything else that we know about what sentiment is as far as banks, as far as the markets, as far as the economy. That's a good looking chart. There's no doubt about that here. I just want to go to one before we get to Liz here, guy. The Nasdaq, the Nasdaq 100 in general. I am very surprised that we have not seen any major tech companies pre-announce. Maybe the dollar coming off. We're going to look at the dollar in a second here, has given them a little bit of confidence. You've remarked on many occasions that Microsoft, one of the first real pre-announcements of mega cap tech was in late June, and Microsoft was warning on currency, right? And we know the dollar was at, multi-year highs at that point. And your concern has been a lack of demand, especially as we're seeing a lot of layoffs in the tech space. And, if you're selling licenses to seats and all that sort of stuff, you're gonna have less of that. Thoughts on the Nasdaq, because it's much closer to its 52-week lows and it's much further away from its 200-day moving average in the S&P. It just feels heavy.
It certainly does. And so the Microsoft, and we said at the time, when Microsoft basically guided on currency, we said, good news is they didn't guide on demand weakness. The bad news is they didn't guide on demand weakness. And that was not meant to be glib or clever. My point there is it's just a matter of time. It's almost a foregone conclusion that at some point they're going to have to. Just reading the tea leaves. And when you see, to your point, more and more of their customers reducing the amount of seats effectively, stands to reason that that's going to affect Microsoft. And, the Microsoft quarter, if you go back the last couple of quarters, I mean, they've been fine, but they haven't been great. And Microsoft is traded at a premium valuation, well-deserved, but it's no coincidence that this stock made its all-time high around the same time the Fed pivoted. So as valuations become more and more in people's purview, Microsoft is not immune from that. And your point that you've made for a few shows now, you saw the Satya Nadella interview from CNBC Asia. I think he was in India, and he seemed extraordinarily concerned, so much so that Jim Cramer reduced or got out of, I don't know which one, but I know at least sold some of his Microsoft position in his charitable trust. And that's a name that he's loved forever, Dan.
Yeah, I mean, the stock closed the year, I think it was 239. It traded down to 220. It got a downgrade from UBS. Satya's comments were taken as a bit of a soft downgrade, or at least seeing some kind of headwinds, from an economic standpoint. He was talking about recessionary environments in different parts of the world and likely to be in the US for some time. It's funny. I took a couple things away from it. It was a 23-minute interview, and, he seems very confident in the strategy in which they have been executing on, and he's done an extraordinary job. They've even done an extraordinary job in M&A under his, tenure. So, he's the right guy for that job.
Hmm.
I don't think he's seen, other than the pandemic since he took over, a meaningful downturn, an economic downturn. So it'll be interesting to see how that works. But I think to your point, it really is a story of valuation. So the stock went from 240 to 220. Now it's back at 220. We're going to get those earnings a week after next. And I think that's going to be, that's going to be the main event when we get, all the major big tech names. Again, I'm surprised we did not see a downgrade in guidance or pre-announcement to any of them. All right, Guy, let's get into it. This is one of your favorite parts of the week. We have, as you like to call her, EY from SoFi. I call her just Liz Young, at Liz Young Strat on the Twitter here. Liz, welcome.
Hi, guys. Happy Thursday.
If we grew up together, which we didn't, and obviously I'm significantly older, but I probably would have called her Elizabeth all through high school, because that's my want to do. Where other people say one thing, I want to sort of go the other way. And I know in the Young family, I guarantee over Christmas, when you're all wearing your feety pajamas, you're Elizabeth.
I'm Elizabeth or Lizzie, depending on who you ask, but
Lizzie,
very rarely Liz.
I just put an image in my head, and all of our listeners, our viewers know that you are from the fine state of Wisconsin, probably Milwaukee. And I could just see Liz growing up in that home in Milwaukee and having this kind of strange Italian guy living above the garage. And his name was
Very Happy Days, by the way. Listen, if you think about what you just described, and I know we got Butters, and I apologize for doing this, but you brought it up. I mean, Happy Days was in the great state of Wisconsin, number one. They had a family. Actually, they were a family of 5 before they somehow just got rid of Chuck altogether. He made it like 3 episodes, then he was gone. But then this strange older Italian dude moved upstairs in their garage. That, of course, being Arthur Fonzarelli, played by Henry Winkler, who was neither strange nor Italian. Back to you, Dan.
Well, listen, and you could also be Lenny or Squiggy from the spinoff of Laverne and Shirley. There's no doubt about that. Wow. So you got all right, Liz.
We're going to go with Carmine the Big Ragu.
We are so off the rails.
Off the rails.
Sorry, please. I'm going to stop.
And we got a lot of stuff to do today. All right, let's get Liz. I'd love to get your reaction. Again, we've been focused on the CPI print. It feels like since the last CPI print. In your note that dropped on the SoFi blog today, I think that's SoFi.com/blog, or a guy would probably just say /blog. You want to look at services, but I want to get your quick take on inflation and the stock market's reaction this morning.
Yeah, first, quick shameless plug for Milwaukee. There is a statue, a bronze Fonz statue on the Riverwalk in downtown Milwaukee. So if anybody ever wants to visit it, great photo op. Okay, CPI today. Bang on expectations, which obviously the market is cheering. The expectations were for it to come down quite notably, and we have a negative month-over-month print. These are all good things, right? This is what we need to see happening. We need to see the trend continue downward, and that's working. The note that I put out today, I purposely chose services because I expected that services would continue to be kind of the problem child in CPI. Now, they did come down marginally, but they also continue to be the problem child. Now, shelter falls into that category of services. We all know that shelter is exorbitantly expensive right now. Over time, over the course of 2023, I would expect that to come down. But here's the reason why I think everybody needs to look at services. We were so obsessed with goods for such a long time. Used cars were so expensive. Everything that we did was so expensive. The semiconductor shortage, all of it, right? Then we get into services. The reason that this is more important is because they're sticky. This is the stuff that sticks around. This is the stuff that isn't as affected by supply. It's going to stay higher for longer. Mm-hmm. And the way that I would just finish this statement is that this takes longer than we think. This takes longer than most people think. This will take longer than I think the market thinks. And yes, we can cheer this number. We can cheer that there's a relaxation in inflation, but 5.7% core and 6.5% headline is really not good.
Problematic. And, again, people will look at the trajectory, and obviously things are coming down. But to your point, EY, services are extraordinarily sticky. And when you talk about our economy, we are a service economy. I mean, we're probably a 70% or so service economy, and it takes a lot longer for these things to abate. And I do think, listen, the Fed can be moving the goalpost all they want. I do think they understand what they're looking at much more clearly this time. And they see exactly what Liz points out. And they say, you know what? We still have a bit of an issue here. So as many people want to say the Fed is doing it wrong, or they're getting it wrong, or we're going to be lowering rates by the end of the year, take a look at what Liz's note says and bear in mind the fact that this is extraordinarily tough to defeat. And I think they're trying to do it correctly. It's just a question of will they do it? More importantly, what will break on the way to getting us there? And that's really what the market is not taking into consideration.
Well, and the other thing, and I don't want to be hyperbolic about this, but so services PMI fell into contraction in the last reading, so below 50. It's never been in contraction without a recession. Look, it's possible. Anything is possible. There's a first time for everything, but this would be the first time for a lot of things, right? This would be the first time that we got out of an inflation problem like this without a recession. It'd be the first time that we saw contractionary services and manufacturing PMI without a recession. And Guy, to your point, if we rewind 40 to 50 years, our economy was so dependent on manufacturing. Of course, goods was really important, and we got so used to watching that. But we have transitioned. That is no longer the case. Services is actually the much more important side of it. It employs a ton more people today. And one of the arguments that I heard today on CNBC and elsewhere was that, oh, but these inflation numbers are already overstating the reality, and things are coming down. These are all lagging. You know what else is lagging is labor numbers. So all of these arguments about labor being so strong, I don't really believe that. And I think that those are on even more of a lag than CPI.
Yeah, so it's interesting when you talk about that stat. You've never seen a contraction in that services data with that wasn't followed by a recession. Another thing that really seems like it's signaling a recession, Guy, is the 10-year U.S. Treasury yield. So we've been drawing a 1-year uptrend, for the better part of the last year. And in this last period, when we've seen rates come off from early November, we haven't really seen a check back to the actual uptrend. There we are right now at 3.5% or so. We're still above that 200-day moving average. And again, Guy, if we were to break that uptrend and kind of touch that 200, which it has not touched in more than 13 months or so, what would the signaling be there to you?
It would mean exactly what you just said, that the economy continues to ratchet down in a meaningful way. Everything that Liz just outlined and what's outlined in her note. And, is it different this time? Absolutely not. Are we able to dodge all these different things effectively happening at the same time? And we don't even mention the fact that in addition to rates, we're talking about a balance sheet that they're trying to reduce, which for whatever reason, nobody wants to take into consideration. I think that's important as well. But if this 10-year yield, which again, I think we've collectively thought is going lower for quite some time, starts to meaningfully decelerate in terms of yields, TLT going higher, means an inversion, I think, is going to go back out towards 80 basis points, if not 1%. And I think people are going to take a long, hard look and say, wait a second, historically, this has been bullish for high valuation, high growth stocks. In this environment, maybe not so much, especially if you start to hear more layoffs from these companies and more slowdowns from these companies. So I don't know how lower rates is bullish in this environment, Dan.
Yeah, the other thing I'll just say, I'm going to throw the Dixie chart up here, the U.S. dollar index. And I think this is really interesting, especially again, and we'll talk to John Butters about this a little bit as we head into earnings season, because, we've seen some massive rallies. We talked about them that May, April last year. Then we had that kind of June, July, and then we had that October. And they were all really in and around earnings season. And a lot of it had to do with sentiment got really bad. The numbers weren't as bad as when they came out. And stocks continue to rally on the way out. All of those rallies, for the most part, happen to coincide with a rising U.S. dollar, right? And here we are now. We saw the Dixie almost touch 115 in September, and we're at 102 right now. And it really feels like easily going to 100 right here. Liz, does this play into this kind of soft landing narrative that it's becoming very pervasive? Okay, first things first. It's also, as I think, is consensus right now that the first half of this year is going to be really bad in the markets, right? And then we're going to kind of find our way in the second half. It seems like there's a lot of consensus thinking, soft landing, the worst is behind us once we get to the second half of this year.
Yeah, it is pervasive. I also think it's naive because the soft landing is right now very predicated upon inflation is coming down, and that's what we should be excited about. Isn't that what our goal was? Yes. But again, you have to, how does inflation come down? It doesn't come down by just an act of God. It comes down because people stop buying as much stuff or doing as much stuff, or companies are losing pricing power, so they lower the prices. That's how inflation comes down. So there's a flip side always to that coin. And when you look at the dollar in particular, no, look, this is good for some things, right? This is good for exports from the US. This is good for multinational corporations. I, however, don't think that the big multinationals are what was going to lead us out of this anyway. So it's good for some of those earnings, but it's not going to solve all the problems. Exports from the US, I mean, trade is a very, very small proportion of our overall GDP. So that'd be great if exports went up and imports went down. But again, it's not going to be enough to offset a lower consumption number. So it's okay to say that soft landing is still alive as a possibility, but I think it is actually just as unlikely as it was 3 months ago.
Yeah, a couple things here real quickly. Yesterday I detailed a bearish trade on the GLD, the ETF that tracks the shiny metal that Guy has been bullish of. Again, this was not something that I was kind of making a long-term view. I was looking at the February expiration. I was looking for a retest of that uptrend and then basically get back towards that 200-day moving average back and fills, looking at February expiration. So that's kind of up 1% today. It's in my face a little bit. I will tell you that I added a little bit to it today. Guy, what's gold telling you right here? Again, I know that dollar weakness, that's helping it here. But anything about the data that you want to extrapolate to gold?
Well, I guess the CPI number came on the screws, so it did not basically impede this lower left, upper right trajectory that gold's been on. I think if it came in, anything 6, 7 or higher, I think your trade would have worked out really well because the market would interpret that as Fed's still in play, Fed still being in place, theoretically should put some pressure on gold. That's what it's done. So this to me, and I never use the term, but it's about as Goldilocks as you could possibly get for precious metals. And you saw the subsequent move. Gold is moving for fundamental reasons, in my opinion, not least of which central banks buying it hand over fist. And very quietly, silver's starting to get off the mat as well over the last few months. So precious metals, I think, are telling the story that central banks are pushing a lot of buttons. At some point, they will break something, getting back to my earlier comment. And the place to be when something breaks, in my opinion, is the gold market, Dan.
All right, Liz, going back to your note here, because I thought this was really interesting. You had a chart of mortgage application activity. And again, we talked about how services are really important, but we also know that the consumer, makes up 70% of US GDP here. And again, we've had lots of periods over the last 20 years where consumers in this country have used their house in a low rate environment as a bit of a piggy bank. Talk to me about what you're thinking as far as just what the mortgage activity and the drop in it of late means for, let's say, the consumer and the broader economy right now.
Yeah, I mean, huge drop. So if you just look at mortgage activity, the numbers are here on the screen, down 81% since the peak in early 2021, 67% down since the end of 2021. Now, that hasn't been entirely reflected in home prices or rents yet. And the reason for that is because you don't see it reflected until those things change hands. So you have to sell your house and have somebody else buy it in order for it to be reflected. And I think that entire cycle kind of got exhausted already. The rent stuff will update a little bit quicker because obviously those turn over faster. But this is a really lagging part of the services sector, a really lagging part of the economy. I would expect, though, because this has been such a steep drop off, that you see home prices come down quite a bit through 2023. And that is not a concern necessarily for people trying to buy a house. But Dan, to your point, if you're using it for a home equity loan, or if you're using it as equity in the home and you bought at the heights of these home prices, you're going to end up underwater. And then you're almost forced to wait until you want to sort of exit that position, if you will. So the thing about housing is it's an unrealized loss or gain until you sell the house, right? But it is realized in your sentiment. So if you feel like you're underwater on your house, not a great feeling every single month when you pay your mortgage.
And real quick, Dan, and I'm not a housing expert at all, but I think I understand assets and liabilities. And for many people, the asset they have is not necessarily their home, but their mortgage. You think about what people did. They refinanced probably longer term mortgages at trough rates. So for them to sell their home now, they probably, for most people, they have to buy another home at an entirely new interest rate. So I think people are making the determination and wait a second, I sort of like where my 30-year or 15-year is. If I sell my home, understanding that I'm going to have to take a new mortgage out at a much higher rate, the math probably doesn't work. So that's the push-pull right here. So I totally understand what's going on with mortgage applications. But to Liz's point, it's just a matter of time, almost a foregone conclusion before prices start to follow. And then one has to wonder, what does the market do under that scenario, Dan?
Yeah. Well, those are great points. And let's throw up a chart of the XHB, the ETF that tracks the home builders in this. And there's some other stuff in there. It's not just a pure home builder sort of thing. But, we get asked questions all the time. Guy, you just said, I'm not a housing expert of this and that. Like when you think about this, someone would say, Liz, you just showed us the data on mortgage applications and they're crashing here. Why would the housing sector, why would the stocks, or at least an ETF that tracks them, why would it be rallying? Well, at some point, when the ETF, the XHB, or some of these home builders were trading near multi-year lows down a whole heck of a lot. I think they got cut in half from their highs, right? About 18 months ago when we were in a housing frenzy, markets start to anticipate some of that. I just think the XHB, interesting. It's getting towards a technical resistance level. I want to throw up really quickly, though, the Wells Fargo chart. And, Guy, we spent some time on this on Fast Money a couple nights ago. There was a story that Wells Fargo, once the number one player in mortgages, is stepping back from the housing market. And the details of that is, like, unless you had an account at Wells Fargo, they are not servicing new mortgages anymore. They're not pricing them. Those are the sorts of headlines you probably want to see when the sentiment is where it is as it relates to mortgages, as it relates to the supply-demand dynamics. Guy, talk to me a little bit about that.
That's exactly right. And the point that I probably made awkwardly, but I think you made better the other night on the show, I don't think it necessarily moves the needle for the stock. And that proved to be accurate. But I think to your point that you made, and I think Tim made it as well, it's not necessarily what it does to the stock. It's the signal that it sends, right? And I think you're going to start looking back. Like, remember back in January when Wells Fargo made that announcement, you're going to start connecting dots. Well, a headline like this, Dan, is going to be one of those dots.
Yeah. All right, Liz, real quickly here on banks. We spoke on the tape on Monday. And listen, people, if you cannot get enough of Liz Young on Market Call on Thursdays or on the IC with the who guy, who's she on with the IC?
Well, typically she's probably on the IC a few times a week with the SDs on the IC.
Yeah. All right. So if that's not enough and you need more Liz Young, you can check her out on the Tape podcast that drops every Mondays. She's going to be doing what we did at IRL. We were in the studio this Monday. That was a great conversation. Really enjoyed that. It was Guy and myself and you. It had a different cadence than this. This is a very visual medium here. You didn't even have your hair done. You showed up from the gym or something like that. You're like, it's just audio, right?
Yeah.
Like a big high pony. I could do that. Maybe I should have a high pony.
So you can swing around.
Like the Fonz. Yeah. All right, real quickly here on the bank. So you heard us talking earlier. We all know it. A huge chunk of the XLF is reporting tomorrow morning here. Many of them have had really big runs. JP Morgan's outperformed. Bank of America has come off those October highs pretty healthily. And then we also see Wells Fargo. Citi, we threw that chart up there yesterday, Guy, during Market Call. That one looks like it's trying to bottom. I mean, the charts look healthy. This XLF is a funky ETF because we know that Berkshire Hathaway is the largest holding, but I just threw it up there because I thought it looked nice. Thoughts here? Are we going to see a breakout? Because this resistance level, in and around this 35.5 level in the XLF, not asking you to comment on the chart. You get above there on fundamental news, we might be out of the woods a little bit in some of these banks.
Yeah, I mean, look, broad, like big picture, if we go into a recession, financials will get hit like every other stock will get hit. However, I don't think they get hit as hard because they haven't really had some of these big rallies. They haven't participated in them except since October, then they started to come back. I think that 2023, and I said this in my outlook, is a valuation story above all else, and financials are just trading at really nice valuations. And if the story also is about fundamentals and is about how well can companies weather a storm or how long can they get through something with durability and make it on the other side, I think financials look pretty good in that scenario too. Also, we're now hearing, we heard about all the tech layoffs. Now it's bled into financials, right? Goldman laid off, I think, 3,200 people yesterday. I believe there was BlackRock had an announcement. So there probably are going to be more of those. The market has liked it when companies are showing the ability to cut costs and trim some things in order to meet earnings and to be able to reinvest in the business or be shareholder friendly. And financials are doing all of those things. Of course, it's not good when people lose their jobs, but as a shareholder, if you're looking for shareholder friendly companies and good stewards of capital, I think you're getting that in the financials.
Before we bring in Butters, and Dan, I'm going to allow you to do that because you're much better than I. Watch me tie a ribbon on this whole frickin' first 28 minutes of the show. I happen to know for a fact that either in middle school or high school, EY portrayed Dorothy and the Wizard of Oz. The Wizard of Oz, of course, I saw when it came out in 1938. We went to the local theater in the
Oh,
city.
wow.
It was wonderful. It was really good. I mentioned all of this, Dan, because you just said a term, are they out of the woods? And if you recall at one point in that great movie, The Wizard of Oz, they sang a song about being out of the woods after they got out of the poppy fields and all that shit, only to have to go to the witch's castle, which at a point there was pretty problematic. That's exactly what's going on here with banks. People think they're out of the woods, but they still got to deal with the Wicked Witch of the West at some point later on, and that's going to come in the form of earnings and commentary. Back to you.
Yeah, so on that episode, Guy, where Liz joined us on Monday of On the Tape, there was also Danny Moses with his former partners of Seawolf Capital, Vinny Daniel and Porter Collins, and those guys were all three portrayed in The Big Short, the Michael Lewis book, and the movie by Adam McKay. And, you know, interestingly, and there's no joke here, those guys are really good on banks. They're really good on financials. Liz, I know that you listened to that episode, and I think Porter had a little PSA for the listener. He's like, if you have money at one of these big banks and it's sitting in a checking account, get it over to a savings account because you're going to earn 4%. And part of their bearish thesis right now on the banks is that, you know, that pull of capital is going to really weigh on earnings as long as rates are this high. Because part of the narrative has been, this is great for banks, right? With banks, with rates going higher. Let's see what they have to say about that kind of, you know, what's happening to those balances and the like here. All right, let's do this thing here. You know, John Butters, he's a senior earnings insight analyst over there at FactSet. We get to look at his work every Thursday before it drops on Fridays here. But here he is in front of Q4 earnings season. We're going to break down a bunch of big trends. John Butters, welcome to Market Call.
Great. Thanks for having me. Good to be here.
All right, bud, we've been tracking your work, like we said, over the last couple of months, and you've been talking about how analysts have been revising their earnings lower over the course of the quarter here, and that seems to have been accelerating over the course of 2022 into earnings, right? And you had a great piece of data a couple months ago that we've quoted a couple times on here and on our podcast On the Tape, is that, you know, over the last 25 years, strategists usually overestimate S&P earnings 1 year out by, I think, about 7.5% or so, which is pretty astounding, especially when you consider where S&P earnings consensus is right now for 2023. I think we could all agree, maybe not you right now, we make a lot of qualitative judgments about this sort of stuff. You rely on the data. That's why we're considered, I don't know, talking heads or so. But talk to us a little bit about, because listen, Guy and I clearly think S&P earnings are too high. They've come down for the current quarter. We're going to start getting this, the reports and the guidance. Where are we right now for Q4, and how important is it to you? Because it looks like they've lowered estimates at a higher rate than they have in the past here. I think starting in September 30th, I think the data that you had was that S&P earnings were expected to decline 3.5% for the current quarter. Now expected to be 4.3, or that's how much they've been cut. Excuse me.
Yeah, this is a trend. It really started last quarter and it's continued this quarter in terms of seeing higher estimate cuts than average. So for this quarter, the numbers came down 6.5% from September 30th to December 31st. And that's above, you know, if you look anywhere between the 10-year average and the 20-year average, it's usually a 3 to 5 percentage point decline. And we did see more negative guidance as well. 67 companies issued negative guidance this quarter. That's above the 5-year average of 57 and slightly above the 10-year average of 65, excuse me. So as a result, as you said, coming into the quarter, the analysts were looking for earnings growth of 3.5%. And because of those revisions, we're now looking for a decline in earnings year over year of 4.3%. And if we do have a decline in earnings, that'll be the first time we've seen a year over year decline going back to the pandemic third quarter of 2020.
It's amazing that people are starting to come to grips with this. I mean, your work has outlined this for quite some time, John, but I guess my question to you is, people still seem to be too enthusiastic. And I'm not asking you to play stock market by any stretch, but you've been doing this for a while. Does the market at these levels appear to be too enthusiastic as well?
Well, it's interesting. If you look at the forward PE ratio today, it's 17, and that's actually in line with the 10-year average of 17. But if we look at the expectations for 2023 going forward, analysts have taken down their numbers for the first half of the year. So just over the last few weeks, we saw for first quarter of 2023 and second quarter of 2023, instead of expecting earnings growth, we're now looking for a decline in earnings for both those quarters. So we could potentially be seeing 3 straight quarters of earnings decline. But to your point, Guy, if we look at the second half of 2023, still very optimistic for growth. Third quarter growth at about 5%, fourth quarter at almost 11%. And as a result, for the full year, looking for about 5% growth. So again, as always, we'll say we're going to watch the guidance, watch the revision to see if we start to see those second half numbers start to come down.
Okay, so as we start maybe the first quarter of earnings that are going to be negative, maybe there's 2 or 3 quarters in a row that are negative. I'm going to look on the bright side and try to talk about this when they stop being negative. Do you feel like analysts revise upward more quickly than they revise downward? I think we've all been a little disappointed with how long it took for analysts to start revising earnings downward and sort of come to grips with what was happening. If and when an earnings recession is over, do you think they start going back up? Is it like 1 or 2 quarters and they're back up, or are they just as conservative on the other side?
Well, there's actually not a lot of examples of when analysts actually revise their estimates upward. Typically, it's downward, as we noted. If you look at any of those long-term average, it's typically down to 3 to 5%. But if we do look at the pandemic as an example, coming out of the pandemic, they were a little slow to revise their estimates upwards, and then we saw rapidly, I think it was 4 to 5 straight quarters of the estimates going up. And not only that, we did see the companies become more positive in their guidance. It was one of those rare stretches in late 2020 through 2021 where more companies were actually guiding numbers higher than positive. So that is something we'll have to keep an eye out for. Again, probably not the next couple quarters, but we'll see if that takes place more in the second half of 2023.
All right, John, let's talk about on the sector level here, because you've done a lot of work there. And again, I think a big part of the 2022 story was the contribution from energy and some of the declines in some of the other sectors. And I know that you had a report out, I think a couple months ago, expecting that the energy sector, which has been a huge contributor, like as we said, and continues to be into 2023, at some point that's going to trail off a little bit. Talk to us about how you're thinking about energy. We know that it's less than 10% of the weight of the S&P 500, but it's been a huge contributor on the earnings front. And then are there other sectors that you have your eye on that could be emerging as picking up some slack, let's say, of the energy sector as it trails off into mid-year?
Yeah, well, as we've talked about the last few quarters, energy's really been the driver of earnings growth for the entire S&P 500. In the second quarter and the third quarter, if you took energy out, we would have had year-over-year declines. But as you noted, the comparisons are getting more difficult for energy. And even though it's still expected to be to have the highest growth this quarter at roughly 62%. It's really not enough at this point to drive overall growth for the index. You take energy out, we'd be looking for a decline of 9% in earnings for this quarter. And then to your question about what to look for going forward, it is interesting to note as we go into 2023, energy is really only expected to be a positive contributor for the first quarter. After that, it's a negative contributor. But one sector that analysts are very optimistic about is the consumer discretionary sector, particularly Amazon. They're expecting a large rebound in Amazon this year. So if we are going into a recession, I think it's going to be difficult for consumer discretionary earnings to really drive the boat for the whole S&P 500.
I agree with that as well. I think more likely, and I'm not but the counter to that is I think more people are getting excited about Amazon, the stock, not necessarily how they're going to do, but people look at this stock that is now, a few weeks ago at least, making multi-year lows and saying, regardless of how their business shakes out, I mean, this is a stock that we've been dying to buy and we want to get our arms around in the second half. So it's not necessarily, I think, going to be how earnings do for a name like Amazon. It's just going to be about the sentiment in the stock market. With that said, to your point, it's going to be very difficult for that sector to do well. And what we appeared, or at least what we think, is about to transpire. And again, you look at industrials, slow down. Is that going to be good for industrials? Probably not. And again, when energy was a big part of the driver, one has to wonder where you're going to get the leadership from, John, in terms of earnings. So, Dan, that's how I sort of dissect this entire thing.
Liz, are there some sectors other than banks? You just told us a little bit how you feel about financials, but when you're thinking about that could surprise the upside, that might bottom prior to, let's say, the worst of the revisions for the S&P 500 that you're focused on?
So healthcare, I have been bullish on for a while. I'm still bullish on that long term. I think consumer discretionary could surprise. And I say that because it's a growthy sector, but consumers are very fickle and they change their minds on a dime. So if the data gets weaker and we go into a recessionary scenario, consumers stop spending pretty quickly. So those would take a further dive quickly, but then I think they can also bounce pretty good on the other side, especially if the labor market doesn't have a typical recessionary drawback.
Yeah, well, that's a good one here, John. I'm just curious, like how focused you on? You heard us talking about the dollar and really how much the U.S. dollar index has come off, and we know as far as S&P earnings are concerned, these large multinationals make up a disproportionate amount of the weight here. So when you think about the dollar, if it were to continue like its path lower, let's say the Dixie goes from 115 to 100, I mean that could quickly turn into a tailwind. And then the other thing for corporate earnings, and then the other point, and again, this is all predicated on the fact that the consensus view that we have is some sort of soft landing in 2023, maybe like a short, shallow-ish recession here. And then the other thing is about rates. We know that companies binged on debt, right, in the lead up to this current period here. If rates were to come in, that's also something that could be a tailwind, at least to valuations for some of these stocks.
Yeah, we did an analysis of the first 20 or so companies that have reported, and it is interesting to note that over half of those companies did see a negative impact from foreign currency, but those are also mostly companies that had a November quarter end. So it will be interesting to see what sort of commentary we get from the companies that have a December year end. But certainly foreign currency and labor costs were two of the factors that most of the companies cited, or the most companies cited, as having a negative impact on Q4 earnings. So obviously it's a small sample. We'll see how it plays out for the rest of this earnings season.
John, your work is unbelievable. We're fortunate to have you. Thanks for being here. Dan, what do they call it when people are in real life? What do they say?
IRL.
Oh, I thought that was like a transit line. Oh, shit. Sorry. John Butters in real life. It's so good to have you. Thank you for that. You should check out John's work. I know most of you do. Thank you, John. Obviously. Thank you, Elizabeth Young, who portrayed Dorothy in the great high school public production of Wizard of Oz.
Middle school. I was 13.
Middle school. Apologies. I was thinking. But more, I think almost as importantly, thanks to our audience. As always, I want to thank SoFi. Get your money right all in one app. Thank you, FactSet, financial data and analytics powered by Tomorrow. They're also our data provider. John, thank you. Liz, thank you. Dan, thank you. Fast Money Night at 5 o'clock is going to be fascinating. Hasta la vista, baby.
All right, guys. Thanks a lot.